Good morning, traders. The Australian dollar just hit a 15-month high at 67.66, but we are seeing, at least for now, a spinning top candlestick form today as price pulls back to towards the 67 handle. The big question is, how come did Aussie rally when inflation actually fell overnight? So it is a bit of a confusing fundamental mix, because you've got a falling Australian CPI versus a hawkish RBA. But there is a critical war here because China also announced some stimulus plan. They've kind of driven iron ore prices higher. Iron ore is a big determinant of how Aussie could move. And then, obviously, of course, there are other drivers, including geopolitical jitters between China and Japan. A weaker overall USD is not just inflation. And technically speaking, we also have or dealing with either an ending or a leading uh, diagonal here. This is an important pattern, especially given we have rejected that trend line and we have had just a second RSI, a double RSI divergence here forming, and we are below the 70. So let's quickly talk about the drivers and then we'll do a technical breakdown. So inflation dropped to 3.4 versus 3.7 expected and from 3.8 before. Normally that would weaken the Aussie, which has been the case, but we don't really see it. I mean, driving it much lower, if that makes sense, and that can be a combination. Due to a combination of a few things, we do see mainly, of course, that the markets are still priced in 35% chance of a February hike, and that was the same as before. This might be because China stimulus, they have actually the plan to cut the reserve requirement ratio (RRR) and provide more liquidity. And this demand, of course, hope from Australia's biggest trade partner is a major tailwind. At the same time, though, we had the greenback probably weaker. So you've got China stimulus, you've got a hawkish RBA, you've got a weak USD that allowed this move to the upside. Okay, but at the same time, you've got the slower inflation, but still above the 3% upper band target of RBA, as well as geopolitical jitters, since gains have been capped following first tensions after China banned exports of dual-use items to Japan yesterday. This, in my mind, isn't just about Japan or China. This is a retaliation against the US's action in Venezuela. Okay, so for me, um, geopolitical risks, increasing geopolitical risks, um, combined with a wedge pattern, retracement, a rejection, double RSI, you know, and the indeed much slower cooling inflation than the RBA expected, at least, could eventually drive the Aussie below 67. And 67 is a major support, because if we lose that level, then we're going to go for the first trough of of this wedge pattern at 66.60, and then the second trough of this wedge pattern at 65.91. And interestingly enough, this is also the 50 Fibonacci retracement of the entire leg to the upside. So personally, this is more of a long-term play. Once we lose actually it can be short and long term. Once we lose the 67 or even before, entering a position down to 65, to 65.93, is a 66, let's call it, would make for me sense. And essentially that might be also a reset on the RSI. And only then I will be buying the dips for at least the previous high initially. If it is a leading diagonal, we are looking at a major 2026 outperformance of Aussie. Okay, after of course the bottom is in here. If it's not, if it's an ending diagonal, we might be looking even for a deeper correction to 61.8 and 78.6, perhaps even all the way back here. So we have to also be cautious and pay attention, add this on the watch list, and look what's going to happen around the 50% if we did get there. Now, as we're looking at the technicals, okay, I want to go down on the 1 hour chart, and I want to repeat this process. Okay, we are going to take that low and the top, and we are looking at on the 1 hour, the peak here, prices could perhaps come down to the 50%. We have had a rejection here though, right? So any move to the downside to me, as long as we are above the 67 handle, it's a buy the dip scenario. Okay. Once, and if we lose the 67 handle, then it's more likely a case of further downside. This is how we'll be looking to trade it. Okay. And there is, of course, different entry strategies you can use here. But there is something important to mention, right? This is not a divergence on the 1 hour. We see a slowdown, but from peak to peak, this is higher on the RSI. So perhaps, since we are now at the 50 RSI, right, perhaps we're going to see either a reset and another leg up, which will drive us here. Oops, excuse me. So we could see something like this play out. Okay. Although, you can imagine that would be a very slow move to the upside. That would be a hidden bearish divergence. Perhaps we would see a different type of divergence, right? Normal divergence. So either way, what I'm trying to say is that a reset of the RSI 50 or perhaps 30 could be seen, which means that we ought to see another leg to the upside, which would potentially fail to cross above the previous high. Perhaps even we might get a, yes, you heard it right, head and shoulders pattern. If the 50% over here at 67.15 or 67, 67.15, that's the territory, like 15 pips, would hold. Okay, so I will be cautious of all of these potential patterns because in my mind, and as I see it currently, this is probably more of a pullback, okay, which would be looking, as I said, on the daily to revisit perhaps not just the 1.066, but also the 10.659, unless if the 67 holds. So I'm putting all my money, as we say, on the 0.67 and what is going to happen around that level. So are you buying the dip at 67 or fading this rally on the divergence? Let me know in the comments. But as always, trade safe.